Hello financial investors and welcome to the channel. My name is Brent and today we are going to be doing our M1 Finance dividend stocks I'm buying today on the 27th of July 2020. We're going to go ahead and kick it off by taking a look at stock futures up on the screen now. Then we're going to go ahead, jump over into the M1 Finance Roth IRA account. Take a look at the overall performance of the portfolio. Take a look at it on a weekly basis. What stocks were up, what stocks were down, some of the activity for last week, what stocks paid out dividends last week, where those dividends are going to be reinvested this week. So that is what we're going to be covering on M1 Finance dividend stocks we're buying today. Now, if you are brand new to my channel, I cover the stock market and dividends. So if you enjoy any of those topics or discussions, subscribe to the channel. If you have any questions or want to let me know what stocks or dividend stocks you're planning to buy or taking a look at, go ahead, drop them down below in the comment section. I do appreciate all your feedback. And of course, if you do find this video fun, helpful, entertaining, give this video a thumbs up and let's go ahead and get into the video. So kicking off the video here, we have stock futures up on the screen now. So right now there is the China market that is open, which we'll take a look at here in just a second. But overall, last Friday, we can see here the Dow was down 0.68, NASDAQ down 0.94, and the S&P was down 0.62. So it does look like in the morning of Monday, we may see a little bit of a rebound to the upside. We'll see how that kind of plays out for the rest of the day. We could we could start off green, but we could go into volatility just depending on what sort of news comes out that day. Now, currently, the Hong Kong China market is open. It is down by 0.42%. So as you saw there in the headline, Hong Kong just released a tech index, very similar to the NASDAQ, but it has some volatility in the first day of trading. So that's some interesting news there on the overseas front. Now, jumping over into the M1 Finance platform now, we're taking a look at the overall performance of this portfolio. It has been active since January 8th, 2018, so a little over 2 years now. It does have some return so far of $2,200. Most of that is from just dividends being paid out in the account. We do have roughly $960 of market gains and $1,300 of earned dividends, giving us our total gain there. Now this portfolio, it's a small smidge of our total portfolios. So I have had some comments in the past saying that, why focus on individual dividend stocks when the main focus should be building up your appreciation overall over time. And I definitely agree. I do not focus strictly on the dividends. I also, when I look at adding positions into my portfolio, I also want to see that these companies have upside potential as far as continue to grow their revenue, their net income, their free cash flow, their earnings per share is growing on a yearly basis. And overall, they may have been hit here in the short term, but over the long term, they generally have a rate of return of 7% or greater in comparison to the total market. So by adding positions into this portfolio, I do hope that it actually has a greater appreciation or return versus just investing in the S&P 500. Now this account has about $24,000 in it. I do have several other accounts out there between Fidelity, M1 Finance, my other M1 Finance account, Merrill Edge, Robinhood, Webull, my Roth 401k at work. So we have multiple platforms out there. This makes up maybe a quarter of our total portfolio or so, and the other portfolios are invested in the S&P 500 or some other growth companies out there. So that is a little comment that I had last week, why the focus on just strictly dividends. And that's not a focus, that's the focus of this portfolio. This is my wife's Roth IRA, and the way that we've designed it is just hopefully to have a rate of return that is equal or greater to the S&P 500 while producing a higher yield return. So with that said, let's go ahead and take a look at the 1 week performance. So here, for example, we did go down last week 0.33%, or about $81. Now when we compare this change to the main index, we can see the S&P 500 lost about 0.28%, the Dow Jones lost 0.76%, and the NASDAQ lost 1.33%. So we are definitely in line, coming in between the S&P 500 and the Dow Jones. We didn't quite fall as hard as the Dow Jones, but we didn't not fall as far as the S&P, something like that. So that is the performance there. Now our greatest performers last week were Cardinal Health, Lockheed Martin, Pfizer, McDonald's, Chevron. Pfizer had some really good information and deals come out with the government last week. They got like an $8.5 billion deal, and they also had some vaccine also stuff kind of going on. Cardinal Health, Lockheed Martin, McDonald's, Chevron. I believe McDonald's has some really good earnings, kind of kicking them up. I do see a REIT, a real estate investment trust, up near the top as well. So quite a bit of positivity out there that you can see. That's why we're basically flat on the week. Now our worst performers down here, Las Vegas Sands, down nearly 9% there. So definitely a big hit there for Las Vegas Sands. Only $311 of equity. That's not a sizable position overall. Main Street Capital down 5.35%. ABM Industries 4.85%, and so on. So we do have a mixture of REITs towards the bottom, a few REITs towards the top. We do have some healthcare towards the top. And I do see Walgreens. I see some tech. So yeah, tech. I don't have too many big tech names. I believe Apple is probably the biggest growth tech name in this portfolio. I do see AT&T in there as well, but not a whole lot there. So quite a bit. It looks like maybe financials did really well, industrials did really well. The mall, that's really interesting to see mall REIT kind of do really well. So it's always nice to have an interesting split in the portfolio to kind of keep it balanced. So taking a look at the activity for this past week. Now last week on Monday we did do 2 stock buys. We purchased Pfizer and Consolidated Edison. So let's take a look at what stocks paid out dividends. Cisco Systems paid out $6.59. Simon Property Group paid out $7.54, and Cisco Corporation paid out $5.90. So if we add those all together, let's go ahead and bust out my handy dandy calculator. So we have 659 plus 754 plus 590. So that is a total there of $20.03 of dividends paid out this past week. Now we combine that with the deposit that we add of $50.23, and that leaves us with our current cash balance of $50.26 there. So this is what we're going to be investing in either one stock or 2 stock here today. So now what stocks are we planning on buying? Now overall, our portfolio does have quite a few positions that are actually negative, with Apple not being close to one of them. We do have Simon Property Group, Tanger Factory Outlet down humongous. These are our biggest losers for sure. I had considered selling them, but there was a comment a few weeks ago left by a viewer that it's better just to kind of hold these. Why cut them from the portfolio when they have much more upside potential versus downside potential in their current state? And if I do cut them, yes, I would then take that hit. I would no longer own those shares. This would be, what was it called? When you commit it, it's actually finite. You actually did lose $520. This is only a paper loss of $520 currently. These shares are still producing me. You saw they just paid out dividends of nearly $8 on a quarterly basis. So, it would take quite a while for that recovery to happen, but maybe down the line, once we're past this current recession, these positions in the REITs do bounce back, and they're not hurting the portfolio overall. They're not going to go much more down to the downside. They're not going to go 100% down to the downside. Let's hope, knock on wood, but we'll see. Altria, Walgreens, Waco Group, Las Vegas Sands, a lot of these positions down here towards the bottom. I'm not too interested in adding additional capital. I believe Walgreens is at a good place where I don't want to add more to it. Community Trust Bancorp, this one has been added to the portfolio recently, but I'm not planning on adding any more to it at the moment. I do believe here in the short term, financials are just going to continue to kind of get hammered, so they may be more opportunity to buy financials here in the future, and not a whole lot of actual positions in the negative that I would really want to be purchasing, but we'll take a look here. So I do have my spreadsheet. I believe I updated it for this past week. So on the 20th of July, that was this last week. So everything here is up to date as far as positions. I did get a dividend increase there. Stanley Black & Decker increased their dividend from 276 to now 280. So that's an increase there of 1.44%. Not a big increase, but an increase nonetheless. So here we went ahead and updated. I'm going to go ahead and sort these from winners to losers. And now we can kind of see here that we do have quite a few positions. Let's go ahead and go like this. So we have 16 stocks in the negative. With our biggest losers, we have 11 of them over 10% down to the downside. But overall, still positive in the portfolio. So these can still go back to the positive, and these in the positive can still go back in the negative, just with market conditions. So we did purchase Consolidated Edison and Pfizer last week. Pfizer, it was negative at the start of last week. It is now positive by almost 4%, but Consolidated Edison is still negative. So this could be one we could purchase again this following week. This one is going ex-dividend. Let's make sure it's actually correct. Yeah, ex-dividend date is in August 18th. So there are a few positions today. Again, today is the 27th. So if we're taking a look, we could still buy EV, Pfizer, Realty Income, but all three of these positions, Eaton Vance, for example, where is my Eaton Vance? So ticker symbol EV right there is positive by 4%. We also have Pfizer, which is positive by around 4%, and Realty Income is up here, up 23.44%. It's really not a lot of moves I can make right now without increasing my unit cost. So we'd have to jump into October. Now looking at October, I do see Walgreens here. Let's take a look at Walgreens really quickly because I know that one is down in the portfolio. It has around almost $900 of equity in it. It is down by 18%. It does offer a 4.62% starting yield, have 44 years of growing and paying out dividends. So here this is showing 43 years of growing and paying out dividends. If we look at the growth rate here on the side, so this information here on the right hand side, this is the dividend growth rate over the past 3 years and the dividend growth rate over the past 5 years. So here they have a dividend growth rate, meaning that on average they increase their dividend by about 6.8% on average per year. That's really good. Using the rule of 72, for example, let's go ahead and just take the average of these, 6.88 and 6.58 divided by 2, and 6.73 is the average. So you take 72 divided by 6.53, I think it was, is equal to 11. So in roughly 11 years, if I were to not buy any more shares of Walgreens, if I were just to let it sit there, reinvest back into itself, or just not even reinvest back into itself, in roughly 11 years, my dividend income from Walgreens of $33 per year or $8.43 per quarter would basically double at the rate of 6.63% on average per year. It would take roughly 11 years for that dividend income to just double up. So that's what I kind of like to look at as well. I don't know if Walgreens is going to be extremely risky. I know last week I kind of talked about it being in retail, being pretty risky. I did actually manage to go to a Walgreens, take a look at the store. They do actually have quite a few customers kind of coming in. I'd have to look at their earnings in the short term. So I do have some time till this one goes ex-dividend. Let's go take a look at, I don't remember how it was on the weekly performance. Was it positive or negative? It was negative by 2.2%. So just kind of interesting to kind of see whether it is worth going for that one just a bit. Now Consolidated Edison, that one is still negative. ED, so that one is right there. That one's still negative by 1.83. I don't have any problem buying more of Ed. That one has $564 invested in it, so I could definitely buy some more. Johnson & Johnson, I believe that one is positive. J&J, right there, positive by 8.23%. So we do have some time. I'm actually going to go ahead and go to Earnings Whisperer here. This is a great website. If you guys haven't checked this website out, I know that we're in the middle of earnings season right now, so I'm not sure if Walgreens has posted their earnings Now this is showing latest earnings per share as of July. So third quarter, Thursday, July 9th, 2020. So Walgreens Boots Alliance reported third quarter May 2020 earnings of 83 cents per share on revenue of 34.6 billion. They had estimated $1.10 per share, so they slipped up quite a bit on their earnings. So that's what shows right here. They came in at 83 cents when they had a consensus of $1.10. That was a miss of 25% there. But their revenue did grow. They stayed in line on a year-over-year basis. So even during the pandemic here that we're in, their revenue has remained the same, but their earnings per share, which is important for their dividend, did go down slightly. So here, if the company expects fiscal 2020 earnings of 675 to 675 per share, including the 103 to 114. So the current consensus estimate is 536 per share for the year ending in 2020. So I think this is a bit high. I think the company itself is aiming probably better in line with what they're believing. Now their earnings miss here is pretty weak, but that's all due to the current state of business right now. So it probably would be a good idea to kind of go through here. I'm going to leave that up. I'm going to read through that in the future. But in the short term, I think Walgreens is still in a good position. It is a bit of a riskier one. Of all the positions here, Cohen X dividend, Walgreens is probably at the higher of the risk metric, but it's still worth investing here in the short term. It's not going to go anywhere. So Walgreens is going to be one of my picks along with Consolidated Edison. Let's go ahead and purchase some of these shares. So we have $70.26 divided by 2. That leaves us with $35.13 between two companies. We're going to go ahead and purchase $35.13 of Walgreens and back in the portfolio, and we're going to go ahead and purchase this one as well and buy sell. Now if you looked at the position, this is showing a return of 2.12%, but this is because this position has paid out dividends. Overall, the market gains is down $10.35 and has earned dividends of $22.51. So not all these dividends have been reinvested back into this company, but here we're adding dividends that were recently paid out plus cash that we deposited in our portfolio to this one, and because it does have a negative market gain, we're basically kind of pushing the unit price down lower on this position. So we're going to go ahead and buy and continue and confirm. And those are going to be our two stock buys this week, Walgreens and Consolidated Edison. Let me know down in the comment section below, are you planning on buying any stocks this week? Do you have anything in mind as far as what you believe the market is going to be doing here in the short term? And taking a look and refreshing stock futures, I did see the S&P, NASDAQ, and the Dow Jones all move just a tick to the upside there. So more than likely we will start off pretty green in the morning, and then depending on what sort of news comes out, because news makes a big effect on the market, and plus there's a ton of earnings going on this week, so I didn't bring up the actual earnings tracker for this week, but that's something here we could take a look at. I know I had that posted up somewhere here. Let's go ahead, if I can bring that up and we can take a look at it together here. If you guys are still kind of hanging out here. Okay, so this week on Monday, some big earners that are kind of coming up is, not a whole lot that I see. I see AG&C in there. I know a couple other YouTubers, other YouTubers out there are invested in this company. Looking forward to Pfizer, AMD, McDonald's, Visa, 3M, Raytheon, Starbucks, Altria. Those are some big ones, some big names up towards the top. Now on Wednesday, Facebook, Shopify, Boeing, PayPal, Qualcomm, General Electric, and General Motors possibly. That would be an interesting one. UPS, Amazon on Thursday, and Amazon, Apple, Procter & Gamble, Google on Thursday. Thursday this week's going to be a big week. There's a lot that can happen this week. Depending on how earnings go, we saw Netflix get blasted at negative 10%. Imagine if Facebook, Apple, Amazon, all these big names here, what if they don't come in line perfectly with how the market has been, treating them here in the short term? Going into this week, currently I did see more weakness in the market versus strength, but depending on how this earning kind of plays out, this will kind of showcase whether will move to the upside and continue our uptrend, or if we move to the downside. So that'll be interesting. Let me know down in the comment section below, where do you think we will go this week? Do you think we will go to the downside? Do you think we will go to the upside? I'd really like to hear from you guys, so let me know down in the comment section below. Go ahead and drop a comment. Subscribe to the channel if you have not yet subscribed. Again, we cover the stock market, dividends, occasionally we cover real estate, but it has been pretty slow this week. And if you did find this video helpful, entertaining, and fun, definitely give this video a thumbs up by smashing that button below and making it blue. So that is it for today's video. Thank you all for tuning in. I will see you next time. Have a great day. Bye.